Well, good afternoon, good evening, or good morning, depending on which part of the world you are coming to us from today. My name is Lyndon. I am in South Africa today, and it's currently 1 o'clock, so it's good afternoon for me. And it's a real privilege to have you all online with us today as we go through our monthly deal review of the deals on the Wealth Migrate platform. I think our purpose is really to make this as interactive as possible. So please, let's start that off. If you could just in the panel, in the chat box or the question box, just drop in what part of the world you are in today, just so that we can start getting a sense. It's great to see so many of you online with us today. And while you're doing that, let me say good evening, and well, firstly, good evening to Paul in Australia. Paul is part of our team. He is the head of global compliance, but also a very savvy commentator when it comes to deals and real estate in general. Good evening, Paul.
Yeah, good evening. Thanks very much, and hello from Australia.
Great to have you online. And then our head of community, Lee, who is joining us from Dubai, I believe, today. Lee?
Yes, I'm in Dubai. So hello, everybody, from a very warm and sunny Dubai today. I'm looking forward to sharing and interacting with you.
Great. So thank you, everyone. As you start, we have Johannesburg, Harare, Germany, Zimbabwe again, the United Arab Emirates. We've got someone from Austria, someone from KwaZulu-Natal. So quite a few different parts of the region still coming through. Thanks and welcome to everyone, no matter which part of the world you are in. This is a reminder for those of you who this is your first time joining us on our monthly review. Not only is it our monthly review, but today is also WealthE Wednesday. And Lee, maybe you could just give us an overview of what is WealthE Wednesday and why do we do it?
Yeah, sure. So WealthE Wednesday is really our way of engaging once a month with our community and really trying to add as much value as we can to you. First and foremost, we drop our deal value on all of our deals on our platform so that you can invest from $1,000, which allows a whole lot more people in our community to partake in the deals that we have on our platform. We also have other offerings around inner circle and joining other parts of our community, as well as a power hour with Scott, where he shares a lesson every month to try and give you some added value as we head towards our next century.
That's fantastic. And Lee, maybe if I know Scott's Power Hour tonight is a really exciting one, and just to enable those who have not signed up for that webinar yet to do so, maybe in the chat box you could just drop the link for that webinar and maybe just a quick summary of what that will be about for everyone who's just joining us now in the chat.
Yeah, absolutely. I'll do that shortly.
Perfect. And let's get going. The second question I have for our community online is a question really around we like engaging our community. We like understanding the wisdom that comes back to us from our investor base. So for all of you, again, please, if you could just go to the question box. Our question for you this month is, what part of the world, which region, which country do you think is the smart place to be investing right now? So a question to get a sense of what our investor base is thinking. If you could invest in any part of the world, where would you be doing it right now? And I see some of the answers coming through. I'm actually not going to read out the answers just yet because I'd hate to influence others who haven't had their turn yet, but I will come back to that shortly, probably in about 2 or 3 minutes. So please feel free to drop in your answers into that question box. So for those of you who this might be your first time, the way this works is we try to spend probably about 25 minutes to half an hour going through all the deals on the Wealth Migrate platform, really just giving you a sense of what is the key points around each deal, what we as Wealth Migrate found interesting, maybe a bit more information about the sponsors who are bringing this deal to our page, and then getting comments from our commentators, Paul and Lee, if they have anything that they're thinking about this deal or something that struck them as really interesting as part of the Wealth Migrate process to bringing these deals onto the platform. And of course, what we're really interested in is your questions. So as we go through the deals, please feel free to ask us questions on any particular deal or generally around the Wealth Migrate process, and we will make sure to get to those. Lee is monitoring that question box, and she will interrupt us at any time to make sure that we can handle your question as soon as possible. Now, the last point I want to make before we actually get into the deals and the exciting bit is, as we talk through these deals, please note we're not advising any of our investors on which deal they should invest in. That is a personal decision. You need to match your own investment strategy with the deal that appeals to you. We are not able at this point to be able to say to each or any one of you that we think this one would suit you better than any other deal. It's just not possible on a webinar like this. So please note that this is not an advice space. It's really a general information sharing so that you can understand more about the deals on our platform. And with that, let's kick off. Paul or Lee, any final points from you before we dig into the details?
No, I think we should just dive right in and start giving value.
Yep, you go for
All
it,
right.
Lynn.
Yeah, let's do just that. So what we're going to do is we're going to start off on, as if Lee, please confirm that you can see my page with the website open.
Yes.
Perfect. So if you had logged into our marketplace as a member, the very first page you see would be your marketplace. For those of you who might not have completed your profile, you can complete your profile. There's also a link to a whole bunch of educational resources around property and real estate investing. However, the purpose of today is to really dive into the marketplace. At the moment, we have some really exciting deals on our platform. There's one or two new deals in the last week that we are very excited. This is the first time our investor base will actually be able to see some of these deals, and I think we will save those for last because I see they're dropping in at the bottom, so I will get to those at the end. And we're going to jump straight into Upside Avenue, the multi-housing income REIT. Now, for those of you who were with us last month, we had the question, which I think is a great question, and that normally Wealth Migrate does not recommend investing in REITs. And so why do we now have a REIT on the platform? And I think the key distinction that we are excited about this REIT is that it's a private REIT and not a public REIT. So let's go into a bit of detail around that. A public REIT is a REIT that's listed on an exchange. So in other words, it can trade like any other share. And because it is tradable on a daily basis, it tends to behave in terms of its pricing more like a stock, like a normal stock in a company on a stock exchange. If people are feeling like they need money or they're getting nervous about where the economy is heading, then the price of that REIT can drop significantly or rise significantly on any one given day, irrespective of the underlying value that's actually sitting in the real estate. A private REIT is one that is not traded publicly on an exchange. It is still a portfolio, a collection of different real estate assets managed and owned by the REIT. But because it is privately held, the price evaluation is done purely based on the actual evaluations by independent evaluators on the underlying asset base. So you're really getting the real estate value in your pricing and not the emotions that come in from traders. Paul or Lee, anything you want to comment about REITs in general and the private REIT here?
No, I didn't. Sorry, you go ahead, Lee.
No, I was just going to throw in a question that we've got through from Hildridge just on something that you've said, to say, what does equity multiple mean?
Well,
that's a great.
I say about my REIT first of all, but what I often think about REITs is often you find when people are investing, it's good to have like an emotional connection to what they're investing in. They like to drive past a building and say, you know, I own part of that building, or I own that building, or you know, they can visit it and see it and touch it, and with REITs often it's not like that because it's often aggregated with a number of different investments. But I think the thing about a private REIT is you do get a little bit more visibility on it, and you do feel like you're part of something because you get to know the people that are putting it together. But that's just what I'd say, Lyndon.
Yeah, Paul, I love that. You know, I think at Wealth Migrate, we've always pushed that we are providing trusted partners, and it's really about the partner. You need to understand and get to know the partner, and I think that brings in that emotional connection that you're mentioning. And in this case as well, you know, we have known the team at Upside Avenue for many, many years. They have brought individual deals to us over the years. and now that they have launched the REIT product, it has a portfolio of 6 different assets at the moment, but as a REIT that is constantly growing. Lee, I want to come back to your question as well, if I can, on equity multiple. Firstly, in terms of there are so many metrics in real estate investing that are important, that when it comes to choosing which ones we're going to put on the prime space on the page, which is really that deal card, we had to make some tough choices. And the ones we went with are definitely IRR, internal rate of return, the timeline, and the equity multiple. The additional one that we really are trying to squeeze in here at some point is going to be the cash on cash return. You're actually how much cash you get every year back on your investment. And we are making plans to squeeze that in here somewhere soon. The equity multiple is literally a multiple based on, if I invested $1, at the end of the deal, how many dollars do I get back? So in this particular case, if you invest $1, in 5 years' time, you'll get $1.64 back. So it's a literal simple way for you to calculate the return you're going to get over the time period. Now, one of the questions we often get on this is, why do we include an internal rate of return? Is it not just literally the equity multiple divided by 5, so in this case 5 years, to get us to the 11.4? And even here you'll see the maths doesn't quite add up if you do it in that simple way. Because what the internal rate of return does is it takes into account when you get your money back. And the best way I can explain this to people who are still for the first time engaging with internal rate of return is, if I said to you, Lee, if I said to you, please, will you lend me 100 Rand, and I will pay you, or $100, and I will pay you back $10 a month for 6 months. You'd go, okay, that's interesting. But if I said, please lend me $100, I will pay you back your $100 tomorrow, and then $10 a month for the next 6 months, or I will pay you back $10 a month and only give you your $100 back in 6 months' time, which one would you rather have? Paul, which one would you rather have?
Yeah, I reckon that I for the second one, to be honest, which you are shaking your head at and saying, really, Lee? But yeah, I want my money in my bank. But yes, I completely understand that.
Yeah, so if anyone was going to say to me, listen, I'm lending you $100, but I'll give you $100 back tomorrow rather than in 6 months, that makes me feel better. I get my $100 back immediately, and there's less risk because I know it's coming back tomorrow. So even though over the 6 months you're getting your $100 back, plus you're getting your $10 every month, so at the end of the 6 months, both scenarios will pay you back the same amount of money. The fact that I'm giving you more money earlier means that you probably would rather have that rather than the one where you're getting more money only later in the deal. And the IRR literally takes when you get your money back into account so that you can compare different deals that might have the same overall return, but where a deal gives you their money back sooner, you will have a higher IRR percentage. Now, it's a very complex formula. I would not recommending that you Google it. It has something like 24 different mathematical constants that get put into that formula to calculate an IRR, but it is an extremely useful and standard term to evaluate deals. And we've really been sidetracked away from this particular deal, but I think that's a very valid point to start with in terms of opening up here. So in terms of this deal, it's an interesting one. We have 11.4% IRR. In this case, the main cash return from Upside Avenue will be about 6% per annum in terms of actual cash dividend getting paid. And their projection is that there's about a 6% a year capital gain that you will accumulate over the time. So that is how we get to the 1.64 equity multiple. Now, if you added the 6 and the 6, you'd think, okay, well, surely the IRR would be 12%. But once again, because you are only getting your capital gain at the end of the time period, your IRR gets penalized a little bit and brings that down to 11.4. let me just check. Lee, are there any questions or comments? That was quite a long-winded explanation from my part. Is there anyone who has raised any concerns or questions around that?
Yes, there's one question. How do the risk metrics look in Wealth Migrate? Defaults or delay payments? So I think we can answer that closer towards the end of the webinar, but happy if you want to jump right back into that right now.
So that's a good question, and the risk metrics. So let me actually bring first into our investment risk category, because I think this is an important part of answering that question. So when you have a look here on every deal page, and once again we can use Upside Avenue since it's our first one, we have an investment risk category, and what we do here is we use the global standard investment categories in terms of risk. They are core, core plus, value add, and opportunistic. And the graph, I think, explains it quite well. A core asset, a core investment in terms of real estate is when you have a really good quality building with a blue chip tenant. So in other words, the tenant will have a long-term lease. The building is in a very good area that will always be under high demand. So think central New York, prime space in London, those kind of areas. Now, because you have a great building in good condition with a good tenant, the price for that building you're probably going to pay is quite high. So the return you get versus your price will probably be quite low, because a lot of people would like this kind of building just for having security. So that, while the risk is very low, it's priced in when you actually purchase the building to give you a low return. A core plus building is maybe a good building or a good tenant, but it doesn't have the whole combination of A plus assets or A plus investments. So while you still have a solid, fairly secure investment, because it's not as secure maybe as your New York or London tower block or office block, there's a slight that you can buy it for slightly cheaper than if it was one of those prime buildings. So it's still a secure asset, still in good locations, but your pricing is just a little bit better, so you're getting a better return versus the price you paid. As you move up the next one to a value add opportunity, this is where the investor, the sponsor bringing us a deal, believes that not only might there be rental returns coming in, but that they can actually improve those rental returns or increase the capital value by doing something, by actually taking action that changes something. So either removing one set of tenants and bringing in tenants at a higher value, or making amendments to the building so that you've increased the capital value over and above what you spend. So it's a little more risky, because here there are a few things you're not so certain of. The sponsor is taking a risk. They are betting on it succeeding, but it's not guaranteed. And then finally, opportunistic is where there's a huge amount of uncertainty. So a new development where it might take 2 years before the income starts coming in, and in that 2 years, a lot may go wrong. The market may change. There might be problems with the construction process, and that's why the risk is higher. But then that's also factored into the price of what you can pay when you buy these buildings. So that will manage the investment risk categories. So now to relate that back to the question, what we do is we evaluate for each deal where in the risk profile this particular deal sits, and that's a process of us engaging with the sponsor to see what they think, but then also adding our own expertise and opinions to include that in the risk profile. Now, some of the things we include here is what country is it in, what area in that country is it in, what is the underlying asset, is it a medical building that has often longer term tenants, is it a short term office block where the tenants might be moving a lot, so you might have slightly higher risk of vacancy. We add all of that into our expertise and come up with a final investment risk category. You'll see on this particular deal that this is a fairly stable investment from our side for two reasons. We gave it a core plus. The first one is because it was spread across 5 or 6 different assets, so it's not just one multi-family building. It's got a whole bunch of different ones, but then also they have diversified. It is not just multifamily. You'll note that if we have a look in the detail under market summary, they've diversified across multifamily, senior living, and student housing. Now, all three of those sectors are sectors that we as Wealth Migrate are normally very interested in, because even when the market has a downturn, they are all sectors that are still needing. There's still demand even in downturns for those sectors. So we find them quite stable, and historically they have proven to be so in the downturns. That's it, I think, in terms of my overview of this project. I'm not sure, Paul, if you've got any thoughts or comments about Upside Avenue and an income REIT.
No, I think you've covered it very well, Lyndon. I've actually met the owners of the you know, who have developed this REIT and been to their place in the States, and you know, very substantial people and good experience, and so yeah, no, I've always had a good feeling about those guys. So it's nice to see that they've made it to our platform.
Great, thank you, Paul. Please feel free to interrupt me if you come across any questions on particular deals as we're going through.
I'd just like to also add that
that sounded like Scott joining us. Good evening, well, good afternoon, Scott, and great to have you on board with us today.
Man, sorry for being late. I just come out of an important meeting that ran over badly, and I'm actually sitting in a little restaurant, but the internet wasn't good enough, so I can see what you're sharing, but I phoned in so that you could at least hear me clearly.
Great to have you online. Is there anything you wanted to add on the Upside Avenue multi-housing income REIT?
I think the only thing that I would say is that with regards to this team, there's a great video that I made with the founder of the team where they were an Inc. 500 company for fast growth, which was really interesting. And on top of that, they've actually achieved the best exit for our clients to date. We've had 6 exits to date, and they actually achieved a 2x exit. So what that means is if someone put in $100, they got $200 back, which was, you know, so you were, as I joined, Lyndon, you were talking about the risk profiles. They like to, you know, look for value add type products, and, you know, where they can specifically add a lot of value. And that obviously is how you can grow that capital growth. I do understand on this REIT that they've gone for a lower risk profile where it's more of an income focus, but I just wanted to, you know, acknowledge the results that they've got. They do have, we do have one asset with them that hasn't performed according to the previous history, but they've worked extremely hard to turn that around, and we're actually on track. So we're not on track from an income perspective, but we are on track in terms of the capital growth multiple, which again comes back to that value add. But specifically on this REIT, they've gone for low risk and more income producing assets.
Yeah, Scott, that's a fantastic comment. And I think just to, if I can add to it, for our investors joining us today, often you'll find that the core and core plus, the return you get is mainly based on the income. There's not going to be that much capital growth because the buildings are there, the tenants are there. There's very little that the real estate investment firm can do to increase the value of the building or to upgrade the rental that you receive. As you move across into opportunistic and value add, you start getting more of your return from the longer term capital gain play than you do on the regular income. And in this case, you're 100% right. Their speciality over time has certainly been in the value add. They've produced phenomenal capital gain returns for investors in their deals, because I think they're also a bit nervous about where the economy in general is going globally. I think their REIT for the last year did start bringing in a few more secure income earning assets, and so that they could balance out their value add portfolio. And it is a combination of that where when we were deciding where to place this investment risk category, we went for core plus because of that move that they've done towards more secure income earning assets. But 100% right, they are great. A great team. I think Paul also said it when he met them. Certainly got huge experience, not only in managing real estate, but in figuring out how to increase the value of their particular assets.
Yeah, and this is a great product for our investors if they are looking to diversify their portfolio into 3 of the main housing sectors that are relatively recession-proof. So because they are all included in there. There is one more question around this one, Lyndon, and it's from Greg. And he says, so if I understand it correctly, if the IRR is 11.4% on this opportunity, we would get about 600 cashback literally, and there would be 600 capital gain per year. Do we then cash out at the end of the 5 years, or can we continue with this investment if it works for us?
Great question. So first, let me come back to the returns. So let's work on the assumption that someone invests $1,000, just to keep it nice and simple. Their model is that on a year-by-year basis, on $1,000, you will get 6% return. So that would be $60 a year that you would get every year in cash dividends paid into your Wealth Migrate wallet. Then when they sell the asset base, or when we sell the REIT after 5 years, because it will have grown in its value by 6% a year, that would be more or less, you're going to need to help my maths here, but it's a 30% growth in terms of its underlying value. A little bit more than that, because it's not a straight 6%, it's 6% every year on including the 6%. So probably about 34% over the 5-year period. So if you had invested $1,000, you would get $1,340 back in terms of your capital gain and return. Coming back to the second question is, can we stay in the deal? So this is a great question, and probably a REIT's an interesting example for us on this. For every deal we go into with investors, we aggregate all the investors into a single structure, a single legal structure. It's part of what enables Wealth Migrate to be, if not the only, one of the only global crowdfunding real estate platforms, is that we have figured out a compliant, safe, and global mechanism for aggregating investors from different parts of the world and allowing them to enter into deals. In some cases, for example, on this deal, we may have 100 investors in this investing through this particular opportunity. Now, for us, no matter what the deal is, it is very difficult for us to enable each investor in that scenario to decide when and where they want to exit. So the majority of our deals that the sponsors bring us have a defined exit period. Now, that's not to say it will 100% exit at that point. If the market is really bad at that point, let's say there's been a market crash, or it's a really down market in terms of the real estate cycle, it would not make sense for the sponsor or the investors to exit just because it's, for example, at 5 years. So there is a bit of flexibility built into the contract, the legal contract that the investors invest through into a deal that allows the sponsor to make a different decision based on the market cycle, obviously within reason. They can't say it's a 5-year investment term and then hold on to it for 20 years. That would not work. So in this particular deal, we will look to cash out of the REIT the entire investment group at that point. And then once again, this particular investment, we are expecting that actually we will have a new cycle starting every 3 months. That because this is a product that we get demand for and that we can go into on a regular basis, you can go straight into the next opportunity to go back into the REIT. Now, we are looking and working with them to have different timelines, so that if there are some people who want a shorter term investment, we will have a 3-year exit time versus a 5-year or maybe a 7-year. So we are working with them to build a range of different timelines, but in general, the group will exit at the same time. Once again, Lee, it's a long-winded answer. I apologize. Please, if there are any follow-ups to that, please do let me know.
Can I add one thing there, Lyndon? I think some of you might or might not have heard me say this before, but we've built all these principles not necessarily based on technology, but on decades worth of property investing experience. So there's 2 things that are really quite important there. One is that if a deal is not performing, with an 80% majority, the investors can vote to actually exit it. Because sometimes you just get in a deal and it just doesn't make sense, and it's better to be able to get out. And equally on the other side of the fence, there's a great story in London where 4 people invested in a building in Green Park, and it was a 5-year investment, and they had an agreement that if any one of them pulled the trigger after 5 years, they had to sell. And that time was October 2008, and they sold the building, and within 12 months, it had regained 100% of its value. So they lost 50% of its value within a 12-month period. And so what we did is exactly again in our agreement is allow the investors that should the market have changed or it doesn't make sense to exit on a 5-year period with an 80% majority can actually hold for an additional 2 years, because in any downward crash, it takes on average 12 to 18 months generally for a market to stabilize, and even 2 years to get back to normality. And so I just wanted to explain some of the mechanisms that we put in place that have nothing to do with technology, but decades worth of property investing experience to also protect investors for those type of eventualities, which don't generally happen, but you need to plan for them.
Great, thanks, Scott. I want to move on. I'm aware of time and that we're taking a long time on that one deal, but I think it was to explain the basics, and hopefully we can move a little bit quicker. The next deal we're going to talk about is the RB Care Homes. Danny Craig, this is a very exciting partner for us, RB Care Homes out of the UK. They operate care homes in both Wales and England. A very interesting business model. They offer a 10% guaranteed cash return every year, and then a guaranteed buyback after the 3-year time period with a 3% annual growth. So in this particular deal, your capital gain is maybe a little less at 3%, but you're getting a remarkable 10% guaranteed cash return paid out quarterly, but over the 10% is obviously calculated per annum. And at the heart of their business is they currently manage around, I think it's 18 care homes now. This was their 17th. They've already closed this pending our final investment into their opportunity with our investors. And we're already talking to them about the 18th care home. If we can get a piece of that, we'd be very excited because it's had a huge uptake from our investor base. And what they do is their main tenant here is actually the UK government. The UK Health Authority is obliged to ensure that people who are aged and who have mental health issues are able to be inside of care homes that provide good quality care, even if they cannot afford it. So the majority of about 75% of their tenant base is paid for by the UK Health Authority, which gives you a very stable long-term tenant in an area that often does have high turnover in terms of the tenancy. But because the UK government is paying, even if there is I think we all are aware, these are at times very tough and hard diseases when someone has Alzheimer's or dementia of some other sort. And I guess at the heart of this business model is looking after people in the last stages of their lives. And even if someone does pass away, the tenant remains because the UK government has a waiting list of additional people who are looking for care, who are looking to be helped and nurtured as they go through this last stage of their life. So with that solid tenant in place, they are able to offer a guarantee on their return. And the way they back this up is that they keep a stake, a 35% stake, where they actually own the rooms, 35% of the rooms in every care home, so that if there is a gap, if there is, for example, a private tenant not funded by the UK government who that room becomes vacant, then they will take the hit themselves as if that was one of their rooms, but ensure that all their investors get their 10% irrespective of the vacancy. So a really interesting model. We've had a lot of opportunities presented to us in the UK over the last year or so. Nothing that has come at 10% per annum guaranteed return. I think they are able to do this because of that core tenant being the UK Health Authority and their business model. You'll see in terms of our investment risk category, this is a core plus opportunity. Once again, it's a stable demand. It's highly unlikely the UK Health Authority will change their policy position around providing health services to the aged with mental health issues, and it would be politically impossible for them to do that in reality when we had the conversations in the UK around this. This is a guaranteed buyback after 3 years. It is a set value at a 3% per annum buyback. So that means a 9% growth over the 3 years in terms of your capital gain. But this is really an income play. This is for people who want to know they're going to get money every quarter at a good return. I'm opening it up to the floor. Lee, Paul, or Scott, any comments or questions that you want to add on this particular opportunity?
Lee, do you want to go first?
Yeah, I'd just like to say that this is a great opportunity, and we've had really good feedback from our community on that. It is a very straightforward investment opportunity with great returns in the UK. The interaction that we've had with this partner has also been great. As soon as anyone's had any questions or anything, they've really jumped online and really helped. So they are very involved in their opportunity, which is nice to see as well.
Yeah, so from my side, Lyndon, I've been investing in England since 2002. So I've nearly got 2 decades worth of experience of UK investing experience. A couple of things which come to mind, which I think are important. The first one is that I had 2 friends, one very good friend and one business colleague, that actually invested in retirement centres, etc. And the laws actually changed, and it caused some conflict. So when we were doing the due diligence, one of the things that we looked into was around the whole aged care market, and it's called the NHS there in the UK, from a due diligence perspective. And people that have again got a lot of experience in the space, and I was quite happy and relieved to find that both of them sort of gave us the thumbs up in terms of the space. So that was great. The second thing I think is important is that we're always looking for sectors. And, a lot of people are worried about Brexit at the moment, and they, is it a good thing or a bad thing? Well, I actually think it's a very good thing, because when there's uncertainty, there's opportunity. And that means the pound is weak at the moment, which means you've got the opportunity to not only benefit in terms of the asset, but you've also got benefits in terms of the currency, because the pound is traditionally weak against the dollar. And obviously the stability will come back in the market. The third thing is that because of that uncertainty, you're also buying an asset at a competitive price. And that is why they're able to get the attractive cash on cash returns, which I think is, I've never seen a 10% cash on cash return in the UK, other than crappy little flats that are way up in North England, where they promise you a return on paper, but they don't deliver you a return. And so, for me, it's something that to look at. And then the fourth thing, that you've heard me talk so much about the medical industry and the aged care industry, is that, when there's going to be a market correction, and please notice I use the word when, because I truly believe there's, one coming, is that medical and aged care and things like this become very, economically resilient, because it's the stability of the income. No matter what happens in the global crisis, in the last crisis and the crisis before that, the government will have to look after, the old people and keep paying the rent, because if they don't, there will be an absolute shitstorm. And that's important. It's really important to look at the stability of your tenant and the stability of your income, not only in good times, but in bad times. So I know that's quite a long explanation, but these are the reasons that I really, liked this deal when you first mentioned it.
Great, thanks, Scott. Paul, anything from you on this opportunity?
And I just like the way you explained it, Lyndon, where there was a good percentage people could earn, but over a period of time, there was also, I think you said it was like 3% each year was added on for the capital growth with the guaranteed buyback at the end. So you got a good percentage, but there also was that what you said, Lyndon? It was just 3% or something each year, something like that.
That's correct, Paul. They guarantee it. It's in the investment contract that no matter what's happened to the market, even if it's dropped, they will still guarantee a 3% and per annum buyback.
Can I just paint a bit of color? Sorry, Paul. Can I just paint a bit of color to that as well? In commercial buildings, and the investors are finding it in medical 2 at the moment, and even medical 3, is that what you tend to find is you don't get large capital growth like you do in a house. So in a house, you generally get quite weak income, but depending on sentiment, capital growth can go up quite dramatically. Whereas in very stable income producing assets, you tend to find that capital growth doesn't change dramatically, because it's not really a sentiment based investment. Very few people in this space make sentiment based investments. They make it based on a cash on cash return. And other than inflation going up and the rental rates going up, and they generally are linked to CPI, and again, CPI in England is between 2 to 3%. And if you don't know what CPI is, it's the inflation index. It's pretty common sense that because the value of the property is related to the income, that effectively the capital growth will be aligned to that income rise, which is linked to inflation. And so one needs to have a mindset where if you're wanting to go after stable income producing assets, that you're investing in them for the passive income, you're not going to get huge multiples of capital growth. If you want to take that risk, then you need to go into other types of investments. They're two different investment categories, which I know Lyndon and the team aptly already explained.
Yeah, great insight. Thank you, Scott. So once again, being conscious of time, I want to move on. You'll see here that we have a range of medical. Yatli, fire away.
Sorry, and it's just around this deal because this is a UK deal that we are investing in dollars. And the question has come back that you invest in dollars, so does this mean dividends are also paid back in dollars, and how does the money flow work for us as investors?
Once again, a fantastic question, and thanks. I think that came from Hilditch, if I'm not mistaken. So Hilditch, thank you very much for that question. I think it's one we get often, and there's a very good reason why the investment is in terms of listed on our platform is in dollars, even though absolutely it's a UK-based investment. So, and that's more a question about the way our system works, our platform works. Core to our platform is the concept that you have a single pool of money in our wallets that you can invest across the world. So when you get returns back, for example, from a USA deal, you can take those dividends and immediately invest them into Australia or into the United Kingdom. Now, our wallet system itself operates in a highly regulated environment. We're currently switching wallet providers as we speak now to probably the best wallet provider in the world in terms of compliance. They are regulated by the European Union, which has extremely high standards. We do not have access and never touch money that sits inside your wallet. It is completely hands-off. A third party operates that wallet, and you are the only people who can extract any transactions from that wallet. Now, the reason I needed to tell you all of that was because one of the challenges wallet service providers have in a highly regulated environment is they are not able to, at this point, and we are working with them and the regulators to explore this, they are not able to do currency conversion internally. So, for example, if you get dividends returned to you in US dollars, and you had as well as a US dollar wallet, you had a UK pound dollar wallet, you could not just simply say, okay, well, switch please my dollars into pounds. There's a huge compliance area around that. So that would mean that if we had two separate wallets, you would first have to withdraw those dollars out of our system back into your bank account and then redeposit them in pounds before you could invest in a UK deal. Now, we spoke to a lot of investors around this, and the general consensus was keep the platform as a single currency wallet for now until such time as that regulatory environment has changed. And therefore, all our deals are converted into dollars when we indicate how much money we're raising. When we accept your money, we then convert it once we accumulate. So let's say we're about to put $500,000 into that UK deal. We will accumulate that as dollars. We will then convert it into pounds when we are paying it across to the sponsor. Your underlying asset sits in pounds. So in this particular case, when your dividends get returned, they are paid back to us in pounds, and we convert it at that day's exchange rate back into dollars so that it lands back in your wallet in dollars. I hope that answers the question, Lee. Great. Probably once again a bit long-winded, but I think as our team knows, if you're going to ask me a question, I'll probably give you more words than you were expecting, so I apologize for that. I'll try and keep them short today. What I wanted to do is move on to the medical buildings, and for our investors, it's interesting if you log into our platform, you'll see that we have 3 medical buildings all provided by Orbvest listed on our platform. Now, the reason we have 3 is because the first 2 went so quickly that they are now closed. So you'll see here, Glenridge Medical 22 is fully funded. We then put up Meridian Medical 23. Orbvest, our sponsor, brought us a new opportunity. That was closed in 2.5 weeks, and that was last week. And this week, literally on Friday, we opened the Old Milton Medical 25 opportunity from Orbvest. Now, Orvest we have a very long history and relationship with. They are specialists in the niche environment in medical buildings. Scott, I'm going to throw it open to you because I know you've been an integral part in really bringing the medical story and how exciting it is to investors globally. Maybe can you just tell us a little bit about why Wealth Migrate does have a strong history with medical and why we like it so much? Is Scott still with us?
Yep, I'm here. I was talking away. I didn't realize my mute was on. So the short story is that I started investing in residential in '99, and in South Africa, and then in London in 2002. I started a business in 2004 helping people invest in residential, and I helped 2,500 people buy into houses or apartments in England, Australia, America, and South Africa. And we were in the middle of the crash in 2009. I was in Bondi Beach, Sydney, and I met two very wealthy business people. And I said, well, what are you investing in? I'm always intrigued what wealthy people are doing. And they said medical buildings. And it was really interesting because I have, without being arrogant, but I have an honors degree cum laude and a master's degree cum laude in this topic. And never once had anyone taught me, why medical. And I always challenge people, if you invested in a hospital or medical building. Anyway, they gave me three reasons. They said, listen, the number one reason is no matter what happens around the world globally, people always need doctors. It's perfect. That makes sense. Secondly, doctors never leave their premises. I thought, well, think about it. Go back to your childhood. Every single one of you, just think back to your childhood and think about whether the premises that you went to as a doctor are still medical premises, and I virtually guarantee you they are. And thirdly, doctors are very good at being doctors, but they're not accountants, so they sign very good long-term leases. And I was like, wow, that's like such common sense. I don't need a financial advisor to give me advice on that. So it's a no-brainer. And anyway, they started investing, but the only problem was back in 2009 is you needed 5 million Australian dollars each, and 8 people put in $5 million each. They put in $40 million, and today that company is listed on the Australian Stock Exchange. It's worth $700 million. And what was interesting is we started going to America back in 2010. I did my first trip there to buy property. In 2012, I went back. And in 2013, I basically persuaded Henny to come over because I saw a bigger opportunity in America. Because in Australia, there's only about 6 major cities, whereas in America, there's 300. And I basically said, we got to do medical here. And then through our partners, Mandy Clark, based out of Durban, we found a medical partner on the ground, or Mandy introduced me, and I found a medical partner on the ground called SG Properties. And we actually raised the capital for the first building back in August 2014. So we've now been in the game for 5 years in medical there. We've done hundreds of millions of dollars, and they've managed to produce a very steady income, which people really like. So that's our love affair with medical, and also with specifically in America, there's a whole bunch of extra things that I could add, like when there's a license on the building. The doctor can't even move because the license stays with the building, not the doctor. So, there's a whole lot of intricacies that I think are important. But the real key thing here is making sure you've got partners that also understand medical. And that's really been our skill set, is finding those partners on the ground.
Thanks, Scott. And Paul, I know you've been involved in the medical journey as well now for 4 to 5 years, if not longer. Anything you'd like to add?
Well, really, I suppose similar to what Scott was saying, but you get the feeling that with the aging baby boomers and all those sort of things, there's so many pluses for it, and also the fact that people can get into a commercial building with a relatively small amount of money, because often, a lot of these things, like I've just been to India and we're setting up our operation over there, and one of the things was surprising because the regulatory structure there only allows people to invest in commercial buildings or business property opportunities if they've got $120,000 to invest, and there's no way for somebody that's got less money to invest in a commercial opportunity. And so what is wonderful here is that you have not only the opportunity to invest, but you also have, well, what you can see by the numbers, even though there's been a few gaps at medical 25, there's a whole lineage of medical buildings and now successful exits that have come out of these. So it's a proven pathway, and one that with us baby boomers aren't getting any less. Well, we're getting less of them, I suppose, but we're not getting old that quickly means that we're all going to end up somewhere in one of these things, and that's what these buildings live on.
Yeah, I love that, Paul. And I think even today, you know, you mentioned that you can, for a lot of people, it's very difficult, as Scott as well mentioned, to invest into, for example, a commercial medical building. If under a conventional model, you would have to have millions of dollars just to be able to sit at the table. And through Wealth Migrate, we've made it available. And today, of all days, being a WealthE Wednesday, the first Wednesday of every month, you can get into these deals from even more reduced rates. You'll see all our deals today have a US dollar minimum of 1,000, which is only for today. It's part of our giving back to the community to drop that amount so that we can open up opportunities to new investors who are just joining us.
I want to add,
Yes, go ahead.
Lyndon, I want to add one thing. It's not only investors that are investing $1,000. So, you know, I've had a number of investors invest more than $1 million in a deal. And what's important is that even if you came to me and you said, Scott, I got $10 million and I want to go buy a medical building, I would tell you that you're absolutely crazy to put all $10 million into one building versus diversifying across, say, 10 buildings and putting $1 million in each. And it's really important to understand the mindset. And the second thing is that as a foreigner, to try and get financing in a foreign country, be it Australia, England, America, it's virtually impossible. And if you do, you get it at a very expensive cost per capital. But by partnering with local partners with a local track record, they get us a very good cost of capital. So a lot of people know the acronym OPM, and a lot of people will think that I'm talking about other people's money. I'm actually not. I'm talking about OPM, which stands for other people's mortgages. And one of the most successful things that technology now allows you to do is to partner with successful people with a track record who also get a mortgage for you, or obviously a mortgage for the building. And that is why you're able to get such attractive cash-on-cash returns that you and I as individuals could not get on our own, even if we had $10 million.
Thank you. Thanks, Scott. I see there are a huge amount of questions that we're not getting to yet. So I want to wrap up on the last deal that I want to cover today and then go straight into some of these really exciting questions that are coming through. So let me just quickly introduce brand new, listed yesterday. You'll see it's not even available yet for investment. It's coming soon. We are probably going to open this in the next day or two. And this is an Oklahoma Class B portfolio. Now, this is from Infinity Investments, a company we have a long history with. We have known the founder of Infinity. I think they were even partners in the early stages of Wealth Migrate's journey 7 or 8 years ago. So people we know well. And this is a very, very exciting deal. The total equity on this deal was, and I use that word quite carefully, was $23 million that needed to be raised. And already $21 million has been snapped up. Through our relationship with Infinity, they have committed to keeping the last $2 million open for us for a short period of time so that we could give our investors access to this opportunity. And then they will, if they have a waiting list of other people willing and wanting to take up that $2 million. So this one, I'm pretty sure will go very quickly on our platform. The key numbers here is you've got a 16% IRR over the 5-year period. This is a 8% monthly 8% cash-on-cash return paid quarterly. What this portfolio is 5 different multifamily assets developments. You can see, for example, the pictures here. There are 827 units in this portfolio. And the current occupancy across the portfolio is 96%, which is a phenomenally high occupancy in a very highly sought after part of Oklahoma City, Tulsa and Oklahoma City. Both areas are strong growth in terms of demand for multifamily units, for houses inside these developments. Really good condition. There is not, once again, Infinity, who have a history and an expertise in doing value add deals. They are also aware that the current market is a little more uncertain, and so they, in this particular asset, have gone for a core plus. Once again, coming back to our risk categories, they've gone for an asset where they really believe they went for good buildings in good quality areas where there's fixed income, or not fixed, but certainly with that high occupancy, with very stable income, and they are generating very strong returns on an investment cash basis. So very excited to have this deal on our platform. I think if you want more information on any of these deals, you'll see that on the platform. You can go and download the brochures that come from the sponsors and read the full investment summaries. Being aware of time, Paul Scotterlee, anything you want to add on this particular opportunity?
I've got quite a lot.
Yeah, nothing from me.
Fire away. Go for it, Scott.
So quite a few things I think are important. The first one is that actually when I went to America in 2010, because obviously we'd had the crash, and whenever there's a crash, there's opportunity. I couldn't find anyone I could trust on the ground, and it was actually Brendan that persuaded me to go back in 2012. And on my first exploratory trip in 2012, I went with Brendan. And multifamily was one of the asset classes that we really wanted to get into. So the two most economically resilient investments during the last crash, and you must understand that residential houses in America lost anywhere from 40 to 70%, depending on the state and the city. And the two most economically resilient things were multifamily, and if people don't know what multifamily is, it's what Lyndon just described, which is where you're buying an entire apartment block with hundreds of units, where multiple income streams, and the second thing was medical. And yet, him and I tried, we put in multiple offers, we tried really hard, and for years and years and years, we got nowhere. We had no track record, and it didn't actually matter how much money you've got. You cannot buy a building if you don't have track record, because there's so many other people trying to buy the same building. It really is. It's quite a difficult thing if you don't have track record. So the way they've solved that is that they've actually partnered with a very influential partner in America with a massive network, and that's how they got access to the deal. So again, please understand that even if you were sitting here with $50 million, Brendan and I used to, in the old days, we'd put out there saying, hey, we're arriving with cash, we want to do deals. And the agents wouldn't even get back to us. So, it's irrelevant. It's all relationship based. The second thing that's really important is that, on this deal, when Brendan first reached out to us, we weren't sure, because a $23 million raise is a really big raise. Certainly much bigger than we've ever done. Our biggest has, been less than 10. And so we weren't 100% convinced that there would be the take-up, which is why we're getting in on the tail end. But where this, provides the investors the comfort is that although 23 million has to be raised, 21 million has already been raised from high net worth investors, with the minimum investment being $1 million if you were new to Infinity, and $250,000 if you were an investor already on their platform. So again, it's pretty much for the elite of the elite. And through Migrate and through the relationship with Brendan, we managed to obviously allow people to participate in a deal that traditionally you'd only be able to get into if you had $1 million, now using the platform. And as Lyndon said, on WealthE Wednesday, you can get in from even $1,000. The third thing I think is critically important is, in terms of what we've spoken about already with financing, track record, and the stability of the income. And again, when one looks at it from a market perspective, when the market in America congests, which what happens when you have an economic crash, is that people in houses tend to sell their houses and they move into apartments. It's like there's a trend in America. You go from the trailer trash people, to like these really crappy apartments, to then what they call condos, and then from a condo you go to a house. And they've got Class A, Class B, and Class C, different types of condos and apartments. And so what Brendan's focusing on here is Class B. It's not the crap in Class C and Class D. It's certainly not government leases, which are called Section 8. But it's also not Class A. And the reason you don't want to go in Class A is that you'll get cash-on-cash returns of 4 to 6% best case, whereas at Class B you're getting an 8% cash-on-cash return, but obviously with the principle of being able to get the value add as well. And so it's a very economically resilient investment during an economic crash. And you've obviously got 827 people paying your different rental income streams. I'm sorry, Lyndon, if I'm talking too much, but there's so much education around this space in terms of what's happening. And I know Brendan's, super excited and got a good track record, and him and I have been doing property together now for a decade.
So the good news, Scott, on this particular deal is that we will very shortly be sending out the notifications for a webinar in which Scott and Brendan will be our guests to talk through this particular deal. We're very excited about that. The dates are just being finalized. Lee has in the chat box dumped a link. So if any of you would like to please register your interest, we'll make sure you get that invitation to that webinar. The link is there in the chat box. Similarly, Lee has put the link to tonight's webinar with Scott, which is the 8 pillars of wealth through real estate. I think we've all heard today Scott's wisdom and insight into not only specifics, but also the general real estate investment. And I would not miss that if I was you. I'm appreciative of the time. So for those who need to drop off, thank you very much for joining with us today. If you do have any questions, please send us an email, or if you go into our platform, please click on the chat bot that sits on our website. Our team is always available to answer your questions. Andreas and Patrick, I do have your questions here, and I'm going to take the time to answer them, but just in case for those who need to drop off, thank you.
Yeah, just before people drop off. And also, start the conversation. We're really grateful for our community. Chat on social media, get involved in our WhatsApp groups, get involved in, etc. Join the conversation. It's an invitation to come on a journey. We're not here to sell property. We're here to invite people on a journey to become a global citizen, to create the freedom they want, to basically earn, to own multiple assets in multiple countries, earning a passive income stream. That's what we get passionate about.
Great, thank you, Scott. So let's quickly go to Andreas's question. I think it's a brilliant question. He asks, since all investments are channeled via Wealth Migrate, what happens to the investments if something, God forbid, happens to Wealth Migrate? This has been bothering me for some time now. Andreas, that's a fantastic question. I'm going to give you a quick overview, but then I'm also going to jump to Paul after that to give you his insight. A key principle for our platform is that Wealth Migrate firstly never directly handles the money. We use third-party, highly regulated people to manage money transfers. So from yourself, you deposit it into a wallet held by a third-party person. That money then goes to the sponsor, but via a SPV. Now that SPV is ring-fenced. In other words, it stands alone, and even if Wealth Migrate had to disappear, your investment sits directly into that SPV, not into Wealth Migrate as a company. So your investment is always secure, irrespective of the outcome of whether Wealth Migrate, anything as you mentioned, has to happen there. In the event that that does happen, there are scenarios where there will be other people who jump in to manage your SPV, and Wealth Migrate will manage that relationship to make sure that happens. But your investment is in a ring-fenced, completely separate legal environment, separate to the ups and downs of any Wealth Migrate event. Paul, I don't know if you want to add to that with your experience and knowledge here.
Well, all I can say in the last few years has been a huge move around the world. You'll have noticed KYC and money laundering and things that have come into being. It means that from end to end, it's very important that you can track the transactions, and that's how Wealth Migrate has built the platform. Even though the money is in external legitimate escrow accounts and it has to travel through to an SPV that's been specially structured for the deal, we have to be ready for a regulator or somebody anywhere in the world to say, what is the pathway of that investor's money? And then once it got into that entity, what earnings have been earned and where did they go? And so, not only, as you're saying, Lyndon, is the money looked after in a proper regulated structures, but the process must hang together. You can't just sort of randomly put things all over the place anymore. It's a very strictly controlled area.
Thank you, Paul. If I can, then I would like to jump to Patrick's question. Patrick, once again, fantastic question. Thank you for sending it through. Your question is, can we also withdraw our earnings to another bank account or only to the one we have used for depositing? So the money laundering rules are very clear. So firstly, the answer is yes, you can withdraw to any bank account as long as that bank account, when we do the KYC, the process where we have to register your account with us, as long as the bank account is in the same name as the entity through which you invested on our platform. So when it comes time to withdraw and you request the wallet service provider to take the money out of your wallet into your bank account, they will check to make sure that if you invested in your personal name, that the bank account is in the same personal name. Now, it can be a different bank account. You can change bank accounts over the years. That's not a problem. As long as the two can be verified to be in the same name as the investment entity, then you can change your bank account over time. Patrick, I hope that answers your question. Lee, can I check, are there any final questions or have we covered them all?
Two things, Lyndon.
No.
One is Brendan Brendan's actually here, and so he sent a message, and so I said, well, come and join us. I'd love to know from him why. I know we're going to do the webinar in the full detail, but for someone that's now living in America, Brendan, what is exciting about the Oklahoma deal for you? And I'm sorry, I'm hijacking things a little bit here, Lyndon. I apologize, but he was online. I thought, why not let them hear from the horse's mouth, proverbial horse's mouth.
Yeah, absolutely. Brendan, welcome, Brendan. Great to have you online. Before you do that, I just want to answer one more question, which is from Karina. Karina asked us, is the Southwark investment fully funded? Karina, no, it is not. The reason I didn't go into it today is purely because we ran out of time. I had it last on the agenda purely because we did spend a lot of time on it last month. It's an exciting opportunity for South African investors, unfortunately limited to South African investors. But happy to talk to you if you have any questions around it or would like more information. Please reach out and I'll make sure that we get that information to you. Brendan,
sorry, Linda, just to jump in there, but I don't know, Brendan, if you can chat because it's not coming up as green. But on Southwark, it's a 18% cash-on-cash return for South African investors. So it's a very attractive debt deal with the first mortgage over the property. If people are interested, we've had a very good uptake in South Africa, for people, and it's also with short liquidity cycles, so six-month liquidity cycles, which people do find attractive. I actually answered Karina's question wrong because I typed it in. I thought she was talking about the London residential deal that actually is about to close, and we had one client that was putting in $25,000 that that at the last minute can't get their money out of the country, and so we are going to allow someone to participate in that at the last minute. But Brendan, if you're there, just shout, dude. I don't know if you're ready to talk.
Let's see if we can activate Brendan. Brendan, can you talk? Let's try and find Brendan.
I did try and unmute him. I've made him a presenter now, if that will help.
It says you're self-muted, Brendan, so you might need to unmute yourself.
Oh, there are.
Sorry, I'm on those.
There you are.
Oh, great.
Brendan,
thank you.
Welcome.
Yeah, it's nice to be online with you guys. Thank you so much for the invitation, and it's super exciting. So it's got to answer your question briefly. While we're so excited, is generally we try and look for deals. As you know, we've been hunting for multifamily deals for years, both together and for the last 4 or 5 years. I've been doing them in the States. We built when I couldn't find deals. Yeah,
and we've done it in Oklahoma, where we all bought ourselves some cowboy boots and cowboy hats, if I remember right.
Exactly. So we know the market very well. In fact, it was one of our top performing residential markets where we just didn't have any headaches. Tenants just paid, and we didn't have to worry about evictions. We didn't have to worry about whether they would pay on time. They just paid. So it was a fantastic performing market for us in the residential space. And for the last 3-4 years, I've been very, very focused on building a multifamily portfolio in the US, and we've done well. We're at about 1,000 units already under management, and we've developed a lot of them ourselves. So when we couldn't find product at the right pricing because the markets were moving so fast, we developed. So we developed a $33 million project in Kingsport, Tennessee that went very well. That was A-class product in an urban environment. We exited there for a 31% IRR. Internal rate of return before we'd even tenanted the whole thing up. So it was a very good outcome for all of our investors. We developed in Greenville. We bought product now in when we could find the right deals at the right income. And I just want to bring that in is what we look for when we're underwriting a deal is our ability to produce income. And I think I saw on one of your Facebook posts recently, Scott, that you should be focused on income production at the moment, and we're all about focusing on the income production. Like if we can't produce the income, we don't do the deal.
Well, it's the way to get wise when the market and the world's about to change. And you and I were in the face of the chaos of America in 2009, 2010, 2011. Where people chasing capital growth, quite frankly, saw their bums for breakfast.
Yeah, exactly. So what's very exciting about this is the biggest deal we've ever taken down. A $75 million acquisition and a $22 million raise. I can tell you this. My heart was jumping out of my throat when I said yes to go raise $23 million, somewhere around there. Because as you know, when you say yes to that quantum, your reputation is on the line. And if you don't close, you lose your reputation, you lose your ability to access those types of deals. And what we found is, as we had to go up the chain in terms of deal size to get the right income, that's what we had to do, because the product that's available in the market at the moment is so overpriced that you can't get the income unless you do a massive value add play, in which case it's actually more like development and less like production of income. And then you've got a different risk profile, because you don't know if you're going to get that uptick in rental after you've spent a lot of capital on a project. So we went up the chain and we looked for bigger projects to be able to compete at a level most other people can't. And we got very, very lucky to get access to this type of deal. We said yes. We put our work boots on and we got busy. And the uptake has been phenomenal. We've raised about 80% of the capital out of South Africa and the rest from the US. And I can't believe that we had so much uptake from very, very wealthy families that we work with, because they're also looking for capital protection in a strong currency that can produce real income. And at the moment, because of the debt that we can get in the US, I mean, we're getting debt quotes coming in now at about 3.8 to 3.9% that we're fixing for 10 years. As you know, you can ride out any financial crisis if you've got the right debt that you fix and you've got the right income, because our income becomes a cash buffer that if things go bad, it doesn't matter what's happening to the capital value of the project if you're still producing the 8 to 9 to 10% cash on cash returns.
Awesome. Yeah, I agree with you. And that's what I was trying to say earlier about the risk profile. Now, well, Brendan, thanks so much for coming online. I know you and I are going to do a webinar in the next, we've got one webinar which is a sort of private for the Med 2 and all the people that own LLCs, etc. So all the previous clients that, quite frankly, you and me helped most of them invest. And then we're going to have a public webinar, I think, on the 17th of September. So if I stand corrected, it's the 10th of September is for all the other people with LLCs, and on the 17th of September, we're going to have a public launch webinar.
Yeah, what I might just add is we have a sense this deal might go quickly. So if you are listening on this particular webinar, if you're an investor, I wouldn't wait for those webinars. I would jump on, Lee has posted a link where you can register interest and we will get hold of you. But certainly I wouldn't wait for that 2 weeks before you reach out if you're interested in this one. I think it might be gone quickly. So I'm hoping that by the time we run that webinar, it might be very close to being too late.
Can I say one last thing, Lyndon?
Yeah, sure, Brendan, go for it.
Is if nobody else wants it, I'm taking it.
Your call has been placed on hold. Please wait.
All right. So for everyone, I think that's it. Thank you, Andreas.
Your call has been placed on hold. Please wait.
I think someone's been placed on hold. I'm hoping it's not one of us. Leo, we still good?
Your call has been placed on hold. Please wait.
Scott's put us on hold. So that's not a problem. Just checking. I think we've covered all the questions.
Your call has been placed on hold.
We are
Please
over time.
wait.
I would like to say thank you to everyone who joined us today. Please do go onto the Wealth Migrate platform. Please do reach out to us.
Your call has been placed on hold. Please wait.
There's huge amounts of opportunities here for you to diversify, so you don't have to choose one. I think Scott made that point earlier. It's a great opportunity to actually spread your risk across great deals. We certainly look forward to hearing from everyone. Brendan, thank you for joining us. Paul, thank you for Australia. I know it's pretty late on your side, so thanks for joining us. Have a good night.
There's one question, Lyndon. Did you see Patrick M's question about the UK?
All right, let's jump onto it quickly. Patrick, around valuation.
I'll answer it for you. I'll answer it.
Do you think that real estate prices in the UK will come down? Scott, go for it.
Let me answer that if you don't mind. I've already mentioned I've been investing there for nearly 2 decades now. And the honest truth is, yes, I do think if you buy off-plan developments and new apartments, they will come down. I think they're dramatically overvalued at the moment. I also think if you buy what Brendan and I were just referring to as Class A, Class B, Class C, if you buy Class A properties, which are the highly sought after properties by wealthy Chinese and people from the Middle East and South Africans, is that they're very aspirational investments, but they don't make very good financial sense. And so when the world economies change, people try and sell those buildings and those properties, and you can actually take a bit of a haircut. However, if you go after income-producing middle-class mom-and-pop assets, very much like what Brendan just described in Oklahoma, and equally in London, and where you're buying buildings that are existing, where you can and add value, etc. I do believe there's tremendous opportunity there, but there is definitely going to be a correction. There's absolutely no doubt in my mind. And the last thing that people need to be aware of is that it's all based on the income. And so if you're buying a very expensive apartment in London for £1 million, and they say, oh, don't worry, it'll go up to £2 million, over a 10-year period, I think you'll probably do fine. But in the next couple of years, I would really plan for a haircut. I think there's going to be a haircut. Again, if you're buying existing property with an existing partner on the ground, where they're sort of buying the building, rehabbing it, and it's got good rental income streams, which is what I've always liked. It's what I've done very well of through the last 2 crashes. I really recommend it, but you've got to have the right partners on the ground. And then lastly, on one of our groups last night, someone was asking about a partner, I won't mention names, that sells land outside cities in England. And, I wouldn't touch that with a barge pole at the moment. I wouldn't touch anything that's not income producing at the moment because I think it's high risk.
Scott, thank you very much. Once again to Paul and Scott, our market commentators for today. Really appreciate having you online. Lee, thank you again, once again, for running our questions and our communities. Please do reach out to any of us from the Invest Space if you'd like to. Guys, that's it for this month. We look forward to seeing you next month. Please don't forget the webinar tonight with Scott. It is going to be a cracker. And with that, thank you everyone for joining us.
And Lyndon, if people enjoyed it, please share it with others. We want to keep growing the momentum. Tell other people about WealthE Wednesday. Tell them about tonight. Share the recording with them. We've all, in my opinion, got a responsibility to let other people know now that they too can take control of their financial destiny, and let them know there's opportunities now, but it's all about sharing. And if we've added value to you today, I really request that you go out and share the opportunity so that others too can participate.
Fantastic. I think that's a perfect place to end. Thank you, everyone. Thank you, Scott. Thanks, Lee. Thanks, Paul.
Everyone. Bye then.
Thanks, everybody.